Hello, optionstrat traders. Steve Ganz here, wanting to share with you another compare and contrast between two trades. In this session, we're going to take kind of I'm going to say a little more of a superficial look, because I'll tell you, butterflies are one of my favorite trades. The class I teach on butterflies is 7 hours long, so you can get really in depth into these. I'm working on one right now for calendars and diagonals. That's going to be probably 5 to 7 hours as well. So obviously I'm trying to condense a lot into a very short video here. So know that this is not going to be comprehensive, but it is designed to kind of give you a sense as to how are they different. So when I modeled both of these up, the market was at around 4,200. I'm doing this as I usually do in SPX. That is my main trading vehicle for a number of reasons, but it also helps illustrate a good way to compare and contrast between different positions. So this is the long put butterfly. We've already explored that a few times this week. If you want more details on that, certainly go back and look at the couple prior videos I've done on it. And I'm doing the same thing I did previously, 50-point wide wings. I'm going out to the June monthly expiration in both scenarios that we're going to look at here. So the thing I want you to notice is that in the put butterfly, you have a long put, and I'm assuming at the money, or in this case, close to the money is where we're putting these on. So you have a long put, then you have two short puts, and then you have one long put. And that creates a defined risk position, as we're seeing here, called the butterfly. You're seeing it bounce around quite a bit here. Market's moving a bit today. Bid-ask spreads get a little wide on these sometimes. Let me refresh these. So it is actually around $1,000 in maximum risk and about $4,000 in gain. We can see our max loss here, what the trade will cost us to get into, which is our maximum loss. And that's true of both of these trades. Both of these trades are defined risk trades. We have about a 25% probability of profit, and these are the break-evens. And then we can, of course, look at all the Greeks, etc. in a moment. But let me come over now and take a look at the calendar. So before I get there, a butterfly, or most trades that aren't calendars and diagonals, we call them forms of vertical spreads. A butterfly is essentially a vertical spread. They call it vertical because the prices kind of go down the chain, or your strikes go down the chain, but you're all in the same column. You're all in the same time period, the same expiration. So it's the vertical is really what you're trading there, is the difference between the 4,200 and the 4,150. Now, time spreads, which gets into calendars, diagonals, etc., they often refer to those as horizontal spreads. The reason they call them horizontal spreads is because when most options programs look at the options chains, you have all of the different strikes vertically. Then you go out period to have your different expirations going out in time. So you can see that's horizontal here as well. So again, sometimes you'll hear calendars and diagonals referred to as horizontal spreads. So let's go look and see a comparable size calendar. What does that look like? How is that different? Well, first thing you'll notice is that it has kind of a different shape to it. This has kind of an arched curve to it. And what is it that makes up this trade? Well, what makes up this trade is we have a short strike at the front period at, in this case, 4,200, because I wanted to keep it kind of the same that the calendar was, or excuse me, that the butterfly was. And then we go out some period in time, and this period in time can vary significantly depending on your goals and objectives. But I modeled this in a way to have kind of a similar overall entry price or risk to the trade. So basically this consists of one short 4,200 put, in this case it's June 16th, and then one long 4,200 put on June 21st. That gives us this general look and profile. You can always tell a horizontal or time spread, because there will usually be an arch of some type that's incorporated in the P&L diagram. So let's talk about how the two make their money. So you can see here we're similar in that, we have a max potential loss of 854. We've got a higher percent chance of profit, and I'll pull these all down so we can contrast and compare these more specifically in a minute. But I want to get back to the whole construction component. So let me come back here to our butterfly. And basically where this tent comes from, it's the difference of what are we selling these two for? Well, in this case, we're selling these two for around $49. So that's going to bring in almost $100 in premium. Then we're buying this one at 76. We're buying this one at 33. Put all those together, and that's what gives us the amount that we're going to pay to get into this position. And where is it we make our money on these? How does that money creep into the whole thing? Well, it creeps in because these two we're selling that are close to the money here. Basically, we're going to have that extrinsic value, that juice, if you will, that's going to drip out of this over time. As that drips out of this, when we get into it, it's going to look like this. As that drips out of it, it's going to be doing this. And our T, what we call our T0 line here, is going to mound up. And this will be our profitability that is coming into the trade. And it's largely coming into the trade because of the decay of these options that we sold here. I like to think of the short options, which are usually the engine behind the profitability coming into most of the types of trading that I do. I like to think of them kind of like an insurance policy. So I sold someone an insurance policy here. And if that insurance policy goes unclaimed, in other words, I sold someone stock insurance, if they don't have a wreck in their stock, or if the SPX does not have a wreck, each day that goes by, I kind of have a little more money I can stick into my pocket, so to speak. And then if the term expires, in this case on June 16th, and there's not a claim against me, well, shoot, I can get all the way to where I get this entire thing. Again, with my personal trading, that's not what I'm shooting for. I'm usually taking these off well before expiration, looking to get my 10 to 15 to 30 or 40% out of each trade. But that's how money comes into the butterfly, as we're relying on these two shorts to dissolve or decay over time. Now, these are also going to decay, but because these were sold closer to the money, they tend to decay a little faster. They usually have a little more what we call extrinsic value in them. Now, let's take a look at the butterfly and see how it happens here. So, same basic principle here. We're going to sell this front one. We're selling that at $50, okay? Then we're buying one, the exact same strike, we're buying that out a period of time. In this case, it's only a matter of days. And we're paying $54.90 for that. Well, what's the difference between 50 and $54.90? Well, that's our net debit there of the $4.90. That's what we're going to pay to get into this trade. So how do we make our money then? Well, if you understand options decay, the closer an option gets to expiration, the faster it starts to decay. So because this is closer in time to where we are today than this one is going to decay faster. Now again, if we look at this, we can see, well, there's $49 worth to potentially decay here, and there's $54 to potentially decay here. But again, if this front one decays faster, it will overtake what this last one is decaying at. And again, that's where our profit comes in. So if we look at this, 3, 4, 5 days from now, it's going to look something like this. And then in a week or two from now, our T0 line is going to be mounted up even more. And again, that's this shorter period, short option that's decaying much faster than the back option is. And that's what brings the profitability into this trade. Again, here, I am never looking to carry this to expiration. And in fact, one thing you have to be very aware of if you're trading time spreads of any type is, remember, this front one expires before the back one does. You do not, in most cases, unless you really know what you're doing, you don't want to be in this trade after this expires and you just have this. So if you enter a trade like this, until you're very comfortable with calendars and how to adjust them, you want to make certain that you are out of your trade totally before whatever your front period is expires. You're going to want to close both of these. Again, as you get more proficient, as you understand exactly what these options are doing, there are a lot of ways that you can adjust these trades and turn them into different things, turn them into iron condors, turn them into call spreads, put spreads, etc. If you want an example of that, I think I shared an example on NVIDIA where I did an NVIDIA calendar. It was only a week or so ago, so go back and look at the different videos, and you'll see that we had a situation where NVIDIA ran up monstrously to where we were at max loss, and while I didn't propose making that adjustment for reasons you'll see in the video, I did want to show people how you could consider one way of adjusting a trade like that. So that's kind of the difference between these two. The other key thing that you need to note, let me pull down the different stats, if we will, on these. So this is our long put butterfly. And again, these were snapped a little bit ago. So the market's moved a little, but I snapped these both right about the same time. So the things that I want to point out here is the put butterfly, you know, your $940 debit, $940 loss. You've got a potential max profit of 40.60 right in the center of that tent. But again, I am never shooting for that. 34% chance of profit. This will be a difference. Our break evens here, 41.59 to 42.40. Now, if we look at some of these numbers here, our break evens, we got a higher percent chance of profit. Our max profit is lower, but our break-evens are wider. So we've got a wider range that we're playing with in this trade, which is nice. You're trading off a little bit less potential profit right at that center peak in exchange for a wider tent. So then also when we get into the Greeks, probably the biggest one that I focus on here is theta. And we can see that in the put butterfly, theta is 12. In the calendar, theta tends to be much, much higher because this front period expires, or excuse me, decays faster than the back period. That's why that theta comes in a bit faster. Now, one of the misnomers or the things that people don't fully understand, and I'll be devoting over an hour on this in my class, is people consider butterflies to be negative vega trades. That means if volatility goes up, a standard butterfly is going to show some loss in it, or it's going, the profit, wherever your T0 line is, it's going to sink in a negative vega trade if volatility goes up. Now, if we look at vega in a calendar, it shows that it is positive vega. So you'll always see people that are making the claim of, oh, I should put on calendars in a low volatility environment because they're positive vega. Again, I'm going to be spending over an hour on this. Calendars aren't necessarily positive vega, okay? And let me just show you. Every software program out there models them that way, and it's not a flaw in the software program. The software program is just using the standard modeling algorithms that have been built out there, your Black-Scholes, and I forget what all the other ones even are. But what it's assuming, what the those different volatility models and different options pricing models are based on is if we show a shift in volatility here, we move volatility up or we move volatility down. I mean, if you're doing this, it looks like it's a no-brainer. Gee, it must be positive vega because if volatility goes up, this thing gets way more profitable. It peaks up at about 4,000 and my tent gets much, much wider. Okay, well, what's happening there is that the modeling software, again, all modeling software at this stage, is showing that the volatility in the short period option, our 616 option, and our back period option, 621, is changing at the same rate. That they both, if I take this from 14 to 24, this is assuming that both of them went up 10%. That's not usually the way option prices move. One might move more or less than the other one does. So what we're ideally looking to have happen here is we want the value of these short options to drop out or reduce in value, because remember, we sold those. So we want those to drop in value as quickly as possible, ideally more quickly than the further out dated options. And under normal circumstances, that is the way it will play out. So that's how, again, this profit creeps in. But how can that get wonky? Well, it can get wonky in our favor if the front period drops out faster than the back period price does, or the back period price maybe increases significantly in value where the front period does not, because again, we're long these. So if these go up in value for some reason and these do not increase as much in value, that's also a plus. So at the end of the day, where your butterfly spreads and verticals and all that sort of stuff, I consider these what I'll call largely three-dimensional trades. We're dealing with the element of up price move, down price move, and changes in volatility. When you get into into calendars and diagonals, you're dealing with what I'll call a four-dimensional trade. So you not only have the up and down price movement, you not only have the volatility movement, but on top of all that, you have the difference in the movement between the front strike and the back strike. So again, if you didn't get all this, don't worry about it. Time spreads, calendars, diagonals, again, you can get really deep on those. My class is going to be probably 5-7 hours to help people, dive into these. If all this didn't sink in right now, just know that time spreads are one of the more complex trades, or one of the trades that don't always act the way you think they're going to act. But the biggest takeaway message I can give you on these is if you do one, again, your max profit could potentially change up or down. Your max loss, so long as you close the trade out before this one expires, won't exceed what you paid for the trade. So that's the big saving grace in these. So you can enter some at some point in paper or very small in like SPY or something like that, and study them, see how they move. Get more education on them. Take some deeper dive education classes on them as well, if you think they're a trade that interests you. So that's it for today, and wrapping up our compare and contrast between the butterfly and the calendar. Take care, everyone.